In this video, let's talk about why investors lose money, my 3 worst investing mistakes, Joe Rogan's podcast, and also what's gonna happen to office REITs. What is up everyone, it's David here. Now before we get started, I just wanna quickly update you on my Australian and US dividend growth investing portfolio. So without further ado, let's go. Now, I took this snapshot on the 22nd of May 2020, and in total, I have around 48,000 Australian dollars invested in this portfolio. To be honest, not much has happened over the last couple of weeks other than the fact that the Aussie market have recovered slightly, and I've invested pretty heavily during this period because I think that these asset prices is going to be once or twice in my lifetime, so I'm just trying to make the most of it. At the same time, I am holding a little bit more cash in my emergency fund because I have no idea what's going to happen. So if something happens, I just want to make sure I give myself enough breathing room to take relevant actions. On the economy side, I don't think we've experienced the worst of our recession yet. I think a lot of our job loss is not temporary, but rather permanent. The airlines will go through a consolidation of players, and as they consolidate, they will look for ways to cut their expenses as much as they can to extend their runway to get back to early 2020 revenue levels. Personally, I think it's going to take them a little while to get back to that kind of revenue level. A lot of those jobs within airlines are going to be lost, and it's going to take a little while to recover, honestly. Now, at the same time, while it's dark for some industries, others will reap the benefits. Like for example, enterprise software companies, collaboration tools, consumer staples, and also e-commerce, they have to ramp up to deal with the demand because I guess that's the new norm. And as they ramp up activity, it's likely that they're gonna hire some of these people who are made redundant in this period. So a portion of those jobs that is lost is probably going to be recovered in industries who are booming and reaping the benefits in this pandemic. So this is my most up-to-date US dividend growth investing portfolio with stake. Now, when I took the snapshot on the 22nd of May 2020, I have around $1,300 US in this portfolio. So far, I am very happy with my portfolio allocation at the moment. I plan to keep them for the next 20 to 30 years. So my time horizon is very, very long. And I don't plan to add new stock to this portfolio right now. If I do, you'd be the first one to know as long as you have subscribed to my channel and clicked onto the bell. But I think moving forward into the future, I'm just gonna keep adding to my positions in this portfolio as much as I can. Like I said, I am holding a little bit more cash at the moment in my emergency fund. I just want to see how the reopening pans out for both US and Aussie banks, especially whether there's going to be more defaults or less defaults. I just want to observe from afar for now, and then as the landscape becomes a little bit more clearer, I will deploy more capital into the portfolio. On that note, actually, if you want a free stock of Dropbox, GoPro, or Nike when you fund your account with stake, link is in the description below. I'm not sponsored. This is just something that I use myself, and I think they are incredible for any Australians who want to invest in US stocks. So if you want to try for yourself, the link is in the description below. Okay, so let's talk about the main topic, which is why most investors lose money. In my humble opinion, I think that most investors lose money because of 3 main reasons. The first one is that they haven't spent enough time to learn the principles of investing. Because if you're grounded in the principles of investing, then you know for a fact that 1, market goes through up and downs. That's perfectly healthy and it's perfectly normal. Secondly, that time is a key ingredient for your investment to grow. It just takes time. It's like baking a cake. It takes time for the cake to rise. You can't rush it. And the third thing is that if you invest money that you need, you're going to be more prone to emotional decision making. And when you're emotional, you amplify the feeling of loss aversion, which really just means that it hurts you more to lose $1 than to gain $1. So when the market inevitably crashes, and it always will, you're going to panic and then you're going to sell those shares at a much lower price. Now, the lack of knowledge compounded by emotional decision making is one of the main reasons why average investors have the worst performance amongst most asset classes, which is what you see on the screen right now. Now, the second reason why I think most investors lose money is that they believe the media and other people are feeding them.
Tesla is up 20%. And in 2024, the share price could be $15,000.
Amazon stock is a recession-proof stock that is booming
despite the public health crisis.
Have you ever wondered why analysts or fund managers go on air to talk about valuations or prices of a particular stock? Maybe because they have position in that stock and they know that markets are hypersensitive to information coming from very prominent figures, especially if they have the backing of a large institution like a bank. Now, I don't need to remind you what happened in 2008 in the GFC when top credit rating agencies gave favorable ratings for at-risk financial institutions and also mortgage-related securities. Now, the point I'm trying to make here is that there's no harm in listening to other people's perspective, but just bear in mind that we don't know what they're incentivized by. So it's important that we investigate and ask questions like, how do I know that to be true? And that includes my videos as well. I'm grateful and I'm very, very thankful that you are coming back to watch my videos every week. I really am. But as much as I want you to watch my videos all the way to the end and gently smash that like button for the YouTube algorithm, I want to encourage you to read more widely, watch other people's videos to get some different perspectives, because those different perspectives will help you grow as an investor. As you grow as an investor, you become more confident in your ability to determine what is and what are facts. And the more confident you become, the less emotional you're going to be the next time we face another economic recession after this one. Look, the one thing I can promise you on my channel is transparency. I will show you all my positions. I will share with you my circumstances and my thinking process behind how I formed an observation or a conclusion to why I invested in a particular stock, or my passive income streams.
Just anything besides my credit card and my physical address.
And the third reason for why most investors lose money is actually pretty interesting, and that's frequently trading the market. Did you know that over 80% of individual investors who frequently trade the market lose money? A research paper came out of Yale back in 2004 where they studied day traders in Taiwan, which at the time, they account for 20% of the trading volume between 1995 to 1999. And the conclusion of this research paper is that 2 out of 10 day traders make money, and fewer do so consistently. And the research paper is in the description below if you are keen. But that research paper was done in 2004, and that was a long time ago. But in 2013, another research paper came out of UC Berkeley found mostly the same results. They found that investors who trade frequently tend to underperform compared to the market. And it's mostly because of transaction costs, overconfidence, and a few other cognitive biases. Now, I can't imagine what the rate of losses are now. Granted that we have internet and we also have online brokerages, day trading gurus. It's more popular than ever. I mean, just look at the search volume on Google Trends for day trading. Over the last couple of years, it has really been on an uptrend. I'm not saying you can't be successful at day trading, but at the same time, this is not something that you watch a couple free online courses and you can do for a living. You have to be prepared to invest years of practice and waking up at grueling hours to meet the market's opening hours and demands. Well, I need to be real with you on something. All of those 3 things I just mentioned about why most investors lose money, I'm guilty of all 3. So let's talk about my worst investing mistakes before we move on to some news. Yep, I didn't spend time to learn how to invest for myself. Even though in university we were taught how to price equities, complex derivatives, and fixed income assets, it's my fault that I just didn't spend time to learn how to invest to build my own future wealth. Frankly, 1, I didn't know where to start, and 2, I didn't understand how important it is to me till after university. As cliche as it sounds, it wasn't until I read Rich Dad Poor Dad and Unbreakable by Tony Robbins that's when I realized what investing can really do for me. So if you're just starting out your investing journey, here's what I recommend watching and reading. The 2 books I just mentioned are great ways to build your foundational understanding when it comes to the markets and investing. Now, there are 2 videos I recommend you to watch, and they're both on YouTube. The first one is How the Economic Machine Works by Ray Dalio. And that video breaks the economic machine down into rudimentary pieces so that you can understand how everything pieced together in an economy. The second video is Everything You Need to Know About Finance and Investing in Under an Hour by Bill Ackman. This is just a great video to understand cash flow statement, balance sheets, and how the business as a whole work together. And the last resource is a YouTube channel that focuses around history, economics, and technology, and that's Jack Chappell's channel. History tends to repeat itself and manifest itself in different forms in the future. And honestly, because of how brainwashed we are from the media and all the information that's available on the internet, we tend to forget how fundamental elements like water can shift economic power from one country to another. Personally, I think Jack's channel have broken down very complex topics like oil prices, water, and colonization in Mars into very simple terms that everyone can understand. And so highly recommend you to check out Jack's channel. And my second worst investing mistake is that I didn't start investing early enough. Now, because I didn't spend time learning how to invest, I didn't really start to invest till I was 23 to 24. And guess where my money was? It was sitting in a bank account rotting away by inflation. If it wasn't rotting away by inflation, I would have spent it because I was an insecure idiot. If I learned how to save and invest, it's likely that my portfolio is significantly bigger and way closer to my goal of financially independent by 35. Oh, and my third biggest investing mistake, you're probably gonna love this one. I tried to trade the market frequently back in 2016. So a few years before I graduated, a bunch of my friends and I decided to participate in Citigroup's stock pitch challenge. The challenge is pretty straightforward. They would allocate you a selection of stocks, and it's up to the students to pick a stock that you want to cover. And based on your research and your analysis, you will present the information to an investment banking analyst and you will tell them whether if it's a buy, sell, or hold. This was in 2014 and we were allocated Qantas. Qantas at the time was going through a really tough time and they were basically going below $1. And based on our research and our analysis, we recommended a buy, and the analysts from the banks were really impressed with our presentation. And long story short, we were shortlisted as winners to go up against other universities in Sydney and then nationally. Anyway, that little taste of success got me thinking more about trading. And in 2016, I started trading a stock called Northern Star Resources, who mines and process gold. And if you wonder where I got the stock from, it was basically from a forum who said this stock was hot. So the 20-year-old me, who basically believed other people's decided to trade this stock. And worst of all, I decided to trade with money that I needed.
Which is a bonus idiotic move.
So because of that, one, I didn't understand what I was getting into. And two, I traded with money that I needed. I constantly checked my phone. So my productivity basically went down the drains and my decision making was just incredibly emotional. Look, I made some small gains and then I lost it within the week. And then I made it within the next week and then I lost it again. Eventually got to the point that I couldn't risk losing any more of my savings. But I'm pretty curious to see how that company is doing right now. So let's take a look. So I bought the stock in 2016 at around $3. If I wasn't an idiot and actually learned how investing works, maybe I wouldn't have traded the stock and just decided to buy and hold. Regardless, I almost lost all of my savings at the time and I was still a university student. So I lost almost 2 to 3 grand. And it wasn't a lot of money, but it was a lot to me at the time. Imagine if I just learned the principles of investing and invested that money into a listed investment company with compound interest. My portfolio will be probably significantly larger at this point. So those are by far my worst investing mistakes. And if there's just one thing you can take away from this video, it'll be investing in your financial education. That will really help you navigate this noisy world of investing. So let's move on with some news because a couple interesting things have happened this week. So I'm pretty sure most people have heard of this one over the week, and Joe Rogan's podcast will exclusively stream in Spotify only from September. There's still going to be snippets of it on YouTube, but majority of the content will be exclusively for Spotify. And what's really interesting is what happened after that was announced. That $100 million partnership with Joe Rogan basically turned into a $5 billion worth of additional market cap for Spotify in span of days. So shout out to Patrick Bet-David's channel Valuetainment for sharing that, because I think that kind of return is absolutely incredible. It just shows how much Joe Rogan is worth to that business. That also sets a new precedent for content creators that if you're able to build a loyal, engaged audience, the marketplace will reward you very handsomely for that. Now, in my opinion, it's unlikely that this will disrupt YouTube's market share in content consumption, because I think the place and time when podcasts are consumed are different to when video content is consumed. With YouTube Premium, I think part of that angle is to enable longer videos to be listened to almost like a podcast. But at the end of the day, will Spotify get an influx of new users? Absolutely. But I think this move from Spotify will push a heavier emphasis from here onwards on the YouTube Premium team and Google Podcast team to move more actively to hunt for content creators on the rise, or maybe even reward more advertising dollars to longer duration videos. So we'll have to see how that pans out. But congratulations to Joe Rogan and the Spotify team. You know, I personally listen to Joe Rogan's podcast and it's It's just incredibly entertaining. Now, the second piece of news I have for you is an article that recently came out of CNBC. And essentially in the article, it's saying that office spaces could be emptier in the future as people decide to work more from home. I think that company will allow a bigger portion of their employees to work from home until we find a way to safely contain or treat the public health crisis. And because of that, the demand for office spaces in the short term will soften. And I think in the long term, it's very likely that businesses rethink how and where the workforce are, and there might be less of a real estate footprint while they look for more of a flexible arrangement with the landlords. Now, office heavy REITs might see the dividends delayed or slashed over the short to medium term, and I think the amount of dividends just won't be the same until office heavy REITs figure a way to efficiently navigate the landscape and grow in the future. So on a brighter note, if company allows employees to work from home more, a lot of the expenses when it comes to office spaces can be reinvested into hiring more headcounts, research and development. So I'm pretty excited to see how things pan out. And that's essentially it for this video. If you're open to sharing, I would love to know what is your worst investing mistake. And on that note as well, if there's anything I can do better in my videos in the future, and also if there's a particular topic you'd like me to cover, just let me know in the comments below. Thank you so much for watching this video all the way to the end. It really does mean a lot to me, and it let me know that you enjoy content like this. And as usual, if you could just gently destroy that like button, because that will really help out my channel out a lot. Subscribe to my channel, click onto the bell, so when I release more videos like this in the future, you'll be the first one to know. And until next time, Otto's gonna say goodbye. See you next time.